Hello, this is Stephen Bentley, enrolled agent and Main Street Certified Tax Advisor. Have you ever stopped to consider that you will spend more of your hard-earned income paying income taxes than on just about any other expense in the course of your lifetime? And we are taught so little about income tax deferrals, tax credits, tax deductions, adjusted gross income, taxable income, marginal tax rate, effective tax rate. Well, in the next 10 minutes, I hope to make all of those things crystal clear to you and show you exactly how they play out on your IRS 1040 form. Because if you don't know the rules, you can't play the game. This video provides general tax information and is not personalized tax, legal, or financial advice. Tax laws can be complex and vary based on your individual situation. For advice tailored to your specific circumstances, consult a qualified tax professional. So, what determines exactly how much income tax you pay? There are many factors. We'll start with tax brackets. Tax brackets are a series of income ranges that determine what percent tax you pay on your income. The tax percentages are the same whether you're single or married, but the income ranges are different. If you earn $50,000 a year, you'll fall in the 22% tax bracket, and if you earn $150,000 a year, you'll fall into the 24% tax bracket. The tax bracket you fall into is also known as your marginal tax rate. By taking a look at an example, you'll see that the tax bracket can be a little bit misleading. So for someone making $80,000 a year, the first $11,600 is taxed at the lowest tax rate of 10%. Between that amount and $47,150 is taxed at 12%. And from that amount to $80,000 is taxed at 22%. Sometimes people get a little concerned that they move into a new tax bracket, but that may not necessarily cause a significant change in how much taxes they pay. In this example, if someone were making $100,527 and moved into the 24% tax bracket, if you followed along with the previous example, you'll see that that really will not impact their taxes that much, because only the last $2 will actually be taxed at 24%. The other things that determine how much income tax you pay fall into what we like to call tax planning. This is where things get more interesting, because we may not have a lot of control over the tax brackets we fall into, but we have a lot more control over the kind of tax planning we can do. On the bottom of what I call the tax planning hierarchy is called tax deferrals. Tax deferrals for most people involve retirement accounts. This is where you put money aside now, but you don't pay taxes on it until you actually withdraw that money from your IRA or your 401k much further down the road. The term tax deduction gets used quite a bit, but many people don't truly understand how these work. Tax deductions are like a discount coupon for your taxes. It's going to lower the amount of your income that the government can actually tax. People get excited about tax deductions, but keep in mind, you have to spend money to save money, and that's not necessarily your best play. Tax credits, on the other hand, are like free money that directly reduce the amount of taxes you owe. So it's not reducing your taxable income, but it's coming right off your actual tax bill. There's actually a secret level, something that's better than all three of those combined. And that's making tax-free income. That is income that is never subject to taxes in the first place. This is where the Roth IRA comes in. It's something you should seriously consider for your tax planning. So now that you've got a better understanding of all those terms, let's see how this plays out on the 1040. The IRS Form 1040 can look pretty intimidating, but we can break it down into basically 9 main sections. The first section is income. How much money did you make? Whether it's from your paycheck, from side gigs, from the interest from the bank, investments, just everything you've made. Then you have adjustments to your income. They're also known as above-the-line deductions. You'll see why in just a second. This is where those tax deferrals come in, whether you made contributions to your IRA, 401k, or a health savings account. Student loan interest is a little bit unique, and we'll discuss that in a second. Once you subtract those adjustments from all the money that you've made, you come up with your adjusted gross income, or AGI. That's why those adjustments are called above the line. The adjusted gross income is the line in this case. Then come deductions, where you have a standard deduction or itemized deduction. The standard deduction is a set amount that the government gives you if you don't have a lot of individual expenses that you think you could deduct. So if you didn't have a lot of mortgage interest or medical expenses or your charitable giving isn't that high, the IRS gives you a standard deduction so you don't have to calculate all that. The interesting thing about student loan interest is it comes in above the line. So whether you itemize your deductions or you take the standard deduction, either way, you're allowed to take student loan interest as an adjustment to your income. Once those deductions are subtracted from your AGI, you have your taxable income, then your income tax is calculated using those tax brackets. If you happen to have tax credits, that's where those come in. Because as we discussed, your tax credit comes right off the amount of tax that you owe. There are several tax credits available. Child tax credits, child care tax credits. There are numerous tax credits available. Once you subtract the amount of your tax credits from how much tax you owe, you finally come up with your income tax due. The big question is, are you going to get a refund or do you still have to pay? And that all depends on how much of your tax bill you've already paid throughout the year. If you get a paycheck from your employer, you would have income taxes withheld throughout the year. If you're self-employed, it would have been on you to submit quarterly tax payments. Regardless of how taxes have been paid up to this point, you may still owe money or you may get money back. So if you're wondering how much do you really pay in income taxes, there's a secret hack and a quick way to figure it out. It's called your effective tax rate. And it's a very simple way to calculate it. There's just two numbers you need to take from your 1040 and you can figure out what your true effective tax rate is. You simply divide your total tax by your AGI or your adjusted gross income amount. Do that simple calculation and you'll see the effective tax rate is much lower than that marginal tax rate. Congratulations! You've taken the first step in saving taxes, and that's understanding how the tax system works. Now that you understand all these terms, you're better equipped to actually start forming your own personal tax strategies. In future videos, I'll be going into the specific strategies that you can take that would address your individual situation. If you found this video helpful, please click the like button. That will help others who are searching for tax information to find this video. Many more videos are on the way. If you'd like to be notified when they come out, please click the subscribe button. Thank you.